begin. All right. Good afternoon, everyone, again. So today we are having our webinar on superannuation economic and market update. And today we have two presenters. One is myself, Natalia Clack. I'm a director of Easy Super, company specializing in self-managed superannuation funds. And we have a second presenter who is Anton Tagliaferro. Anton is, he's got 35 years of experience in investment and has a director of Investment Mutual, PTY Ltd. So we'll talk about, I'll introduce Anton later on, but I would like to begin with a disclaimer. So the information provided on this webinar is general information only, and we didn't take into account your personal circumstances, financial objectives, and needs. Therefore, you shouldn't be relying on this information to make a decision, and you should consult with your financial advisor or accountant. So this is a disclaimer I have to do. So I'm the first presenter, and I want to introduce myself. So like I said, I'm a director of Easy Super. We are a boutique company specializing in everything SMSFs, such as SMSF establishment, compliance, audit, and advice. So I have more than 18 years of experience specializing in SMSFs. I have a master's degree in accounting, CPI qualified, ASIC registered auditor and tax agent. And what it means like for last 18 years, I've been doing superannuation only. So I know everything about superannuation, and there is no problem I can't solve because I've seen it all. So today we are going to discuss the changes, upcoming changes for superannuation from 1st of July 2022, and also changes which new government might bring. So what we know about the changes, and this will be my part of presentation as a superannuation expert, and also we are going to discuss market and economic update with Anton Tagliaferro, which is very exciting as well. Let me just see if I can admit few more late comers, and few people are joining us. Few more people are joining us. Again, I want to repeat the disclaimer. So we are discussing superannuation update, and we're also discussing market and economic update today. And this is a general information only, so we don't take into consideration your particular circumstances, objectives, and needs. So you don't have to, so therefore you shouldn't be relying on our information. It's a general information only, how explain. So let's start. So with superannuation, this is something where I've been passionate and excited about. I've been doing it for 18 years. I've been watching what people do around their super. And I want to ask a question. Do you think you have enough for your retirement? You can put in the chat box, who thinks they have enough? I don't, I personally don't have enough for my retirement. And I'm thinking about quite often what I'm going to do when I retire, like how I'm going to live, what I can afford, what I can't afford. Who thinks they have enough for their retirement? So no one thinks they have enough? Anton, do you think you have enough for your retirement? Maybe only. Maybe only Anton have enough for the retirement, but he worked very, very, very hard.
I hope so. I think if anybody's owned a house in Sydney in the last 20 years, you've probably got enough. But anyway, that's okay.
Let's look at it. So, all right, people saying certainly not yet, none, I don't. So yeah, I don't have enough for my retirement, Eva. So, and how much do you think you need for your retirement? Do you know how much you need? Do you want to spend 50 grand a year when you retire? Do you want to spend 500 grand a year when you retire? Or you are minimalistic, you can spend, say, 25 grand a year, because some people do. Do you think you are going to live on age pension? So what do you think? Just think about it. I know some people are far away from retirement. Some people in their 30s, they think it's far away, but time flies, like we say. So you need to start thinking about when can you retire and how much you'll have. So this is a little bit of statistics. So according to ASFA, comfortable standards for retirement, they calculated if you own your own home, this is a disclaimer, if you own your own home, for singles it's 46 grand a year, and for couples 65,000 a year. And for some people it could be enough, 46,000 a year, say if you don't have, if your children grown up, if you own your own house. However, for me, definitely, you know, like I would say it's not enough. So I wanna more, I wanna enjoy life more. So who thinks it's enough, 46,000 for singles? So if you were single and own your own house, who thinks it's enough? Anyone thinks so 46 grand, you can, you know, do cool things? What do you think, guys?
Doesn't sound like a lot, does it, Natalia? But anyway.
No, for me it's not, but everyone's standards are different. But according to ASFA, this is a comfortable retirement. So this is, you know, should be enough for you to comfortably live. Yeah, you can exist but not have any fun. This is Marian is saying. That's exactly right. I mean, you can have fun. You can buy bicycle and ride the bicycle, and you know, you can go for walks. This is what I love doing. I love going for walks. You can join the gym. Probably you can afford to join a gym as well, but not something like that, right? So not something where you sit on a boat. A boat looks a little bit old, but it's okay. Even old boat would be great, right? To go on a boat, to go on a boating, to go fishing, or to go overseas on a cruise, or to travel more, to buy a new car maybe every 3 years. So yeah, this is what we want. And I wonder if 60, what did we have here? 60 something thousand, 65,000 for couple is enough to have this lifestyle. I don't think so. And here are the numbers again. So as per canstar.com.au, so reputable source, to get the annual income of 50 grand, you need to have, and you want to retire at 50, not a lot of people will retire at 50, but you need to have 873,000 in super, or say in assets somewhere apart from your house. If you want to retire and live on 100 grand a year, you need to have, look, 1.7 million if you want to retire at 50, or 1.2 million if you retire at 67. So like from my experience, most of people, most of my clients, they want to retire between 60 and 65. This is the average retirement age. And we are looking, basically, if you want to have 100 grand a year, we are looking 1.4 million sitting somewhere. And also the other assumption that it's paid monthly until the age of 85. So basically what it says that by the age of 85, you exhaust all your super. And if you live by say 100, like some people will live until 90 or even 100, good luck to you after that. So this is what we know about the superannuation, which is why I've been passionate about, you know, helping my clients, helping people to build wealth in their self-managed superannuation fund, and you know, to improve their superannuation position. So we don't provide the investment advice. My company doesn't provide investment advice, but we provide strategic advice around self-managed superannuation fund and tax effectiveness. So what are the changes for superannuation coming? So what's going to happen in the next few months or even years with a new government coming, with some changes already made by the previous government? Let's have a look at that, and let's see if we can, if you can utilize any of the strategies and improve your superannuation position, grow your super. Let's start with the first change, which is superannuation guarantee will go up. At the moment, it's 10%. It will go up to 10.5% from the 1st of July 2022. This is the government intention to, by the 2025, to have 12% superannuation guarantee, compulsory superannuation. And a Labour government is planning actually to increase it even to 15%. It's not legislation yet, but they could propose it. So they are thinking of proposing to increase superannuation guarantee. The reason is because people do not have enough to retire. They don't have enough for retirement, and more people will live longer. It means our superannuation has to last longer as well. Also, the government is scrapping 450 minimum income threshold. What it means if you are only getting $450 a week, so you still month you will get the superannuation guarantee paid for you. Before, the employer didn't have to pay the superannuation guarantee. So these low income people, or say teenagers working, they were missing out on superannuation, which is not going to happen from 1st of July anymore. So the second change, which coming from 1st of July, is downsizing contribution. This is type of contribution which is available for older people. It used to be for people over 65. From 1st of July, downsizing contributions are available for people from the age of 60. So again, the intention of the government is to boost your super, to make people put more money into super, encourage people to pay more money to self-fund their retirement. So the superannuation contribution, downsizing contribution, is a 300,000 per person, and say for couple it will be 600,000. There are other conditions. You need to sell your home, you need to own your home for more than 10 years. So yeah, but there are, like I said, there are other conditions you have to meet to be able to contribute extra money. And this contribution is not a part of the contribution cap. What it means, it's an extra money the older people can put in again to grow your super. And why wouldn't you want to grow your super? If you're over 60, in Australia, if you're over 60 and retire, or if you're over 65 and you don't have to retire, you can take your superannuation out. Plus, if you start a pension, you're over 60 and you start a pension, where, like I said, if you're over 60 and retire, or over 65, you can start a pension, then all your income in superannuation is tax-free. So it's a zero tax on income. So if you have a house, for example, you own in your super, not the house you live in, but the house you rent out, and you're getting the rental income, say 50 grand, if it's under your personal name, you're paying tax on it. If you're in the super fund, you're paying zero tax after retirement. Before retirement, again, if it's a concessional treatment of 15%. So why wouldn't you want to increase this amount of super if you're over 60? So the next change from 1st of July is the maximum withdrawal from the first home super saver scheme. This was brought by the previous government. So now to stimulate new homeowners to buy the first home, obviously. So it's now increased from 30 grand to 50,000. So which first home buyers can withdraw from their super. However, this was an initiative was brought by the previous government. A new Labour government already indicated that they want to preserve superannuation benefits until retirement. What it means that this particular withdrawal from superannuation could be scrapped in the future. I don't know what's going to happen. I don't have a crystal ball, but watch out. This might go with a new government because they're not big fans of taking money from the superannuation. Okay, the next change. Individuals after the age of 75 with total superannuation balance under 1.7 million will have opportunity to make bigger contributions. Again, this is something where we use it as an advisor. I use it for my older clients to boost their super, and this will be very useful again for people who in the past were not able to contribute, like at the older age, were unable to contribute as much as they wanted into super. Now again, this initiative to boost the superannuation contributions for older people, to make sure that people are self-funded then at the retirement age. And the last change from the 1st of July we have, it's individuals. Can you see this little guy? He has to work very hard to meet the work test in order to be able to contribute to super. Because at the moment, if you're between 67 and 74, you have to meet the work test, which is working for 40 hours in 30 consecutive days in order to contribute into super. Again, because your income in your super fund when you're 67 could be, will be definitely tax-free. Plus, you can take any day all your super out, and it's tax-free as well. So from 1st of July, you don't need to work for 40 hours in 30 consecutive days anymore. So it means that people who are retired, don't have jobs anymore, say mom and dad, mom never worked in her life, she doesn't need to meet the work test in order to contribute into super. However, if you want to claim a deduction in your individual tax return, it's slightly different. Again, there are strategies and there are additional rules you need to know around contributions, which again speak to your financial advisor for your particular circumstances. So let's see what Labour government is going to bring to the plate. There are no major shake-ups announced from the Labour government. I think they, like still thinking if they should touch the superannuation taxation, because it's really very, very, very concessional. Only 15% tax on your super and 10% tax on your capital gain if you hold your assets for more than 12 months. And after your retirement, meet certain conditions, no, zero tax. It's like paradise. So let's see what Labour government will bring. But at the moment, so what we know that they're going to review coalition superannuation fund performance benchmarking. It's more for the bigger funds to be able to compare the funds between themselves. They also committed to increasing superannuation contributions, like I said, continuing. So on a path of 12% by 2022, they also have plans for 15% to make a compulsory superannuation 15%. But let's see how they go with this initiative. They also, Labour government is against taking dipping into super. For example, when COVID-19 hit, we were able to withdraw, say, if you were experiencing hardship, you were able to withdraw $10,000 in 1 year and then another 10,000 in another year. So Labour government is against such initiatives. They don't want people to be dipping into super. They want to preserve superannuation until retirement, which is why I'm thinking, with this first home buyer scheme, it might go, because this is dipping into super. So, and also Labour wants businesses to pay superannuation at the same time they pay wages, which is, again, I'm not sure it will be legislated, because a lot of businesses would find it difficult to pay, say, fortnightly, to pay super fortnightly, because of cash flow and also a reporting requirement. So this is what we heard from the government so far. We don't know what's going to happen again, in these 4 years, and let's hope they're not going to put some or increase tax on superannuation, or do something about capital gain tax, but who knows? who knows what's going to happen. So these are all updates, you know, like in regards to what's happening from the 1st of July and what's happening with the Labour government, what are their plans for superannuation. And now I'm opening up for questions. So if anyone has any questions about what I just discussed, or any other questions about superannuation, like I said before, if it's not personal advice, I can answer any question you might have. Any questions, anyone? No, I can't see any questions. That's good. I guess all questions will go to Anton. Okay, I can see someone wants to ask a question. No? No.
Hello.
Hi.
Yeah,
hi,
Tony.
Antonio. How are you?
Not bad. Yeah, just following what you're saying. With you know, we're in our older age bracket, and we've had some money issues on that in the past, and we're currently in a situation where my wife's nearly 70 now, and I'm just turned 67. So what you've been talking about, that's all news to me about this new. When does that apply, and does she need to, because we never had very much money in there, not even 15,000 in the super fund left because of the troubles we've had. Because my wife had been, you know, any withdrawals, we've had to try and keep everything legit and stuff. It's just now that we don't have to demonstrate that my wife in a wheelchair at 70, I can put some more money back in and she can go back into accumulation mode, or because I really don't understand it. I don't know if the accountant really understood it properly to explain it to us.
Yeah, look, I understand your question. Unfortunately, I can't answer your question because, again, you're talking about particular circumstances. I can answer you generally. So what's happening from 1st of July 2022, but this is the reason why you have you should have an accountant who understands superannuation like deeply. So basically, you can contribute, as a general rule, people can contribute until the age of 75. However, from the age of 67 to 75, in order to be able to contribute, there are a few conditions you have to meet. You have to look at your total superannuation balance. You have to look at your work test. From the 1st of July 2022, there is no work test required. So what it means that people, even if they're not working, but have spare money sitting somewhere, they will be able to put money into the super fund. And again, as a general, you know, the amount they can put, look at the caps. Superannuation contribution caps, 27,500, which is a deductible contributions. However, to be able to claim a deduction for contributions, you need to meet the work test. But if you don't claim in the deduction in your personal tax return, it's 110,000 per year or 330,000 in 3 consecutive years. So basically, the rules, they are quite complex. So if you want to have a look at your particular circumstances, again, you need to speak to someone who is a financial advisor, who's got a license to talk about superannuation, and they can have a look at your particular circumstances. I can only discuss a general rules with you. Unfortunately, this is, you know, like what government requires me to do, and I can't discuss your particular circumstances. However, you can always, you know, reach out. I will leave my details at the end of the webinar. You can always book appointment with me, and we can have a look if how we can help you to grow your super. But you definitely need to have someone who understands the superannuation, understands the rules and changes. And like I said, which is why I've been specializing for 18 years, and I don't do anything apart from super because the rules are so complex. So to understand them deeply, to be able to help the clients, like, and to grow their super and implement the best strategies, you need to, strategies, you need to be specialized. So I'm happy to discuss with you, Antonio, later on. Like I said, if you want to make an appointment, please feel free to make appointment, and we can go through your, like I said, for your particular circumstances. But I need to do particular paperwork as well. Okay. So
thank you very much.
yeah, sorry, I just, like I said, you know, like I answered what I could. So I have another question. What does it go 0% if okay, so if wife and husband are different ages, how come, you know, it works in terms of the taxation? So everyone has their own balance in a superannuation fund, if it's a self-managed super fund, or if it's an industry or retail fund. You have your own member balance, your own basket, and tax are applied to your own basket. So for example, if husband is 60 and retired and started a pension and has zero tax, then zero tax will be applied to his member's balance. And if wife is 20 and she's still working, so, and then 15% tax will be applied to her balance. So basically, this is how it works. In order to calculate the taxation properly, as an accountant, I need to do the actuarial certificate. So it's actuarial percentage, which is applied, and this percentage is based on proportion. So if one has 90% of the super fund balance, then 90% of, say, husband who's got zero tax, and approximately 90% of the super fund will pay zero tax. And if wife has 10%, her balance is only 10%, and she's got 15% tax because she's under the age where she can retire, then, you know, 15% will apply to her 10% balance. But it's based on actuarial percentage, which we need to get from actuary. So it's all calculated, it's all mathematics. Yeah, so this is how it works. What are the ages for males and females? Are they flexible? The age for retirement for male and female, it's the same. So there are conditions you have to meet in order to retire. So first condition is preservation age. And preservation age, you know, used to be 55, but for people born after 1960, it will be 60 years old. And so you need to meet preservation age, which is 60 years old, and you need to retire from at least one place of employment, or you just need to turn 65. Once you turn 65, you don't need to retire, you don't need to do anything. This is meeting the ultimate condition of retirement, which is 65, age of 65. So again, age 60 and retire from one place of employment, or age 65. This is how it works with, you know, like with superannuation and retirement. So, and it doesn't matter again if you are in the industry fund, retail fund, or self-managed superannuation fund. The rules for superannuation are the same. Okay, so do we have any other questions? I can't see. No, 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 yes, no, no. All right, so if you don't have any other questions, let's move to the most exciting part of my presentation, which is introducing Anton Tagliaferro. And I'm very, you know, glad and excited so that Anton could make time and participate in my webinar. Anton has more than 35 years of experience in investment. He was one of the first fund managers in Australia who started, you know, like who started the management fund. And he's the director of Investor Mutual, the company he started, I think, 22 now or something years ago. So
25 actually.
How many?
25 years ago.
25. So I remember 20th years of anniversary. So now it's 25. So He's also director on the board of directors of QV Equities. Of course, he's CR qualified member of FinCEA, and also Anton just received a medal of the Order of Australia, and I want to congratulate Anton. This is for his charitable work, because Anton does a lot of charity work, and also for his investment work as well. So we are very pleased to have Anton on our presentation, and eager to hear what's happening with this crazy world, with economy, with the markets, because everything just in the last few months turned upside down. So we need to know and hear what's happening, and would be interesting and exciting to hear Anton's opinion on all this, because he's been around for longer and he definitely has more experience than I do in this investment world. So let's welcome Anton. Let me just switch, make Anton the presenter. So he can start presenting.
So you can see me?
See you, we can't see your screen. If you could share, please, your screen, then everyone could see your screen as well.
In terms of the slides, you mean, yeah?
Slides, yeah, slides.
Okay, is that share?
Yeah. Oh, no.
No. I'm not sure where the slides have gone.
Present on the bottom, P. Can you see the PowerPoint on the bottom?
Yes.
Yeah. So yeah, this one, you have to click that one.
So that's me, is it? So that's me slide.
Yeah. So now we can see it.
So that's me. Okay. So that's it. So you can see the slides, you can hear me, and etc. Yeah.
Yeah. All good.
Okay. Terrific. Okay. Thanks, everyone. So look, I'm not going to take a long time. As Natalia said, it's been a very challenging few months, and very confusing, I guess, for a lot of people to try and understand what's going on. And no matter how many years you've been in the market, it's always a challenge when periods like this happen. So what I'm going to try and do is summarize, what has happened, why it's happened. Trying to forecast is obviously very difficult. Look, at the end of the day, when you think about your superannuation, you've really only got three choices in a sense of investments. You have really, for most people, it's either cash, property, or shares. So shares are obviously a very important part of people's portfolio. I think most people in this country have got a good percentage of their money invested in shares, because over the long term there's no doubt that shares can do very well, particularly quality shares. I'm a big believer in that. But just to go on with the presentation, if you look at the markets basically till about December of this year, you'll see they've been, more or less in a steady upturn. You'll see actually in where it says December 19, obviously markets fell heavily in the March quarter as we went into COVID. Clearly, when governments decided to close the whole world down because of the new virus, clearly that was quite cataclysmic for the economy. Shutting every business, stopping all travel, whatever, and markets fell very heavily initially. Then, of course, what happened, if you all recall, central banks all around the world cut interest rates to zero everywhere. Governments all around the world decided to give all these handouts, including in Australia, where people were getting, I think, 700 a week, or whatever it was, 750 a week. On top of that, central banks were also pumping a lot of cash into the economy to keep it afloat, because clearly, when you shut every business in your economy, that's a pretty serious economic event. So, basically, as I said, central banks and governments threw everything they could. And what you can see from that December 19 to March 20, the markets took off, led by the NASDAQ in the US, of course, which almost doubled, over that period. From March 20 to December 21. And why did it double? Well, lots of reasons. Number one, Clearly, people were using, the NASDAQ in the US is a representative of mainly sort of technology companies. Number one, obviously, the internet did extremely well when we were in lockdown because everybody was buying online or using Facebook or playing video games or whatever, so everybody was online or betting online, whatever. And number two, I guess the other thing was, when interest rates were at zero and people were sitting at home, it had all this speculation, turn up in the NASDAQ, people buying all the, stocks which really weren't worth a lot of money were going crazy. So, basically from March 2020 to December 21, you can see we had a very strong rise in the NASDAQ. The orange line is the S&P 500, the US market, which also did well. And the Australian market, you'll see, also picked up, but didn't do as well as didn't rise as steeply as the US markets. Clearly, since December 21, the first few months of this year, we've seen a downturn, and the next slide shows, so the S&P 500, the overall US stock market since the 1st of January is down over 20%. The NASDAQ is down around 30%, and the ASX 300, the Australian stock market, is down about 12%. So these are very, very steep falls, particularly, in the US market, and we're in the middle of this correction, clearly very, very, a bit unpredictable at the moment as to where we're going. Why has this happened? Why suddenly after that huge boom in the stock market from that COVID low, what's happened? What's changed? So clearly, one of the things which is, all over the media, you can see this is a chart of inflation over the last 20 odd years. And you can see really from that December 06 all the way to December 20, you can see inflation sort of around that 2% level, more or less. The blue line is Australia, the red line is the US. However, you can also see, in over 2021, and certainly going into 2022, we've seen this huge jump, this big spike in inflation. So that now inflation in the US is at 8%. In Australia, the Reserve Bank is saying inflation could hit 7% by December this year. In the UK, inflation's hit 9%. These are quite very, very high inflation numbers, which have seemed to have caught central banks by surprise. And possibly, why has inflation jumped? Well, I guess there's various theories. Clearly central banks and governments threw so much money at the economy that they've probably overstimulated as a result of all that stimulus. They've probably stimulated too much, so demand is too high. We've also had obviously a lot of impact from COVID. We still have a lot of supply restrictions. For example, China is still locking down, so it's hard to get components for certain things, so there are some supply shortages. And on top of that, of course, recently we had the Russian invasion of Ukraine 3 months ago, which has led to a big spike in the price of oil, coal, wheat, etc. So, put all those together and you've got this very high inflation scenario at the moment. Now, some of those things are one-off and will work their way through. But the question is, nobody really knows, where will inflation come down to? Clearly, central banks had this 2% target for many, many years, and they were successful at managing inflation around the 2%. Clearly, there's a big gap between sort of 7, 8, or 9% and 2%. So, central banks are now doing what they can to bring that inflation number down. If you look at the bond market, again, over the last 20 years, with the blue line being Australia, the red line being the US, you can see, bond rates, your 10-year bond rate, your government rate, has come down very steadily over that period. And you can see, obviously, in the last few months, as inflation, the realization that inflation is initially central banks were saying it's transitory, inflation will disappear once COVID disappears or whatever, once supply lines are open, etc. But clearly, inflation has gone on even higher than anyone expected. and you've seen bond rates in the US get to over 3%, and in Australia they hit 4% only last week. And what that means on the next chart, the best one to this is the line of the blue line is the Reserve Bank's cash rate, the red line is the US rate, but let's just focus on the blue line being the Australian cash rate set by the RBA. You can see, and most of us will remember, 10 years ago we were sort of getting 6% on our term deposits, and that was, as you can see there, 2010, because the Reserve Bank cash rate was around 4%. We've seen that cash rate come down. If you remember, before COVID, we were maybe getting 3% on our term deposits, as the RBA cash rate was around the 2%. As I said, when COVID hit, the RBA cut interest rates to zero, basically their overnight rate to zero, which led to record low mortgage rates, etc. And what we've seen, and you can see even with the red line, we've seen now the central banks, they have to put those cash rates up. Okay, so the RBA now has moved in the last few months to a cash rate of 0.8. The Fed Reserve in the US is around 1.8. And there's no doubt, everybody understands and anticipates that those rates are going to go up further in the next few months. As I said, central banks now have to bring inflation down. And one of the ways of trying to bring inflation down is by putting up interest rates, which slows economic activity, which slows demand, which will probably increase unemployment, they've always, in my years and years in financial markets, there's always been this saying that interest rates are a very blunt tool, and they are a blunt tool because they impact everything. So obviously when rates are cut, everyone likes rates to be cut because it's cheaper to borrow. We see house prices going up, share markets going up, on the other hand, when interest rates go up, obviously it's a bit more, it's a bit painful because obviously mortgage rates go up, the cost of money goes up, etc. So, we're in a period now where that cash rate has to go up, and that's what's impacting share markets and investor confidence. Just very quickly, in terms of which sectors, this is the Australian market, which sectors have performed well, up. This is from the 1st of January. Not surprisingly, energy, because the oil price has really doubled really since the beginning of the year. Particularly, it took a big spike when Russia invaded Ukraine. Utilities have done well. A lot of that is related again to the oil, the energy sector, and materials have actually done okay. That's things like BHP and Rio, because commodities as a whole have done, up until this date, reasonably okay. On the other hand, if you look at these other sectors in Australia, the information technology sector is down almost 40%. Again, that's just NASDAQ, which, as I said, was in the US, the information, the IT stocks in the US, which have fallen heavily. Consumer discretionary in Australia is down 27%. Consumer discretionary is things like JB Hi-Fi, Harvey Norman, etc., because obviously people now are anticipating that once interest rates go up, people will have less money to spend. So we will see less spending in many retail shops. We've seen property trusts come off substantially as well. People obviously investors worried about the valuation of properties as interest rates go up. Communication services is down heavily as well. That's not really, that's really reflecting things like realestate.com and Domain, which are sort of internet-based and related to property. Healthcare stocks as well, which are quite defensive. They're down heavily. They're down 10%. And staples, which is your Coles and your Woolworths, they're also down almost 10%. So look, it's been a very tough 5 months, 6 months, whatever, of this particularly the last 3 months, as bonds have sold off and central banks have started putting up interest rates. You've seen a sell-off, a big sell-off in markets all around the world, including Australia, with some sectors, as I said, being impacted a lot more than others. So what does it all mean? Well, from here on, obviously difficult to predict, but we are in a period now where, as I said, inflation is elevated. It has to come down, and central banks will bring it down somehow, you know, and one of the ways they'll bring it down is by putting interest rates up to slow the economy. So we're in that period now. We don't know how far they're going to have to put interest rates up to bring that inflation down to their 2% target. What all that means is the economy is going to slow. You know, the economy has to slow. That's why they're putting interest rates up. They need to slow everything down to bring inflation down. That means that the share market is going to remain volatile because clearly, you know, while it's fallen quite a bit already, and there is some value showing in some sectors and some stocks, it's going to remain volatile because there is a lot of uncertainty. Nobody knows, you know, will the interest rates being pushed up push economies around the world into recession? You know, that's the big question. So, and there's a lot of debate about will the US go into recession? Will Australia go into recession if interest rates keep being pushed up? So look, what we're doing anyway, we're looking to buy, you know, good companies in weakness. As I said, at the end of the day, you know, as investors, we don't have that much choice in terms of what we can invest in. It's shares, cash, or property. Clearly, if you have cash, term deposits are going to be going up, which is sort of good, I guess, if you have cash and you want to earn money on term deposit. Property at the moment, obviously, the outlook is pretty clouded, given rates are going up. And shares, as I said, you know, again, another mixed bag. You know, it's going to be tough for a little while and volatile because of all the uncertainty around. So, look, the sort of companies we try to buy for our portfolios, and certainly the sort of companies I've focused on over the last 30 years, you know, we like to buy companies with competitive advantage. In other words, you know, large companies, big profitable companies which are number 1 or 2 in their industry. So if you think about things like in the supermarkets, you know, Coles and Woolworths, you know, very strong companies, very hard for, I mean, Aldi's come in, taken some share, but, you know, Coles and Woolies remain dominant, you know. Telstra, again, lots of competition, but they remain dominant. So we like companies. I've always liked companies that are, you know, very strong in that, in their industry. We like companies with recurring earnings. So when you think about it, you know, I mean, obviously every company gets impacted. Every company's earnings gets impacted by the economy, but some less than others. So if you think about, you know, Woolworths and Coles, their earnings obviously go up and down a little bit with the economy, but they're relatively steady because people will always buy food and go to supermarkets. You know, on the other hand, if you think about Boral, for example, which is involved in building materials, it's a lot choppy. You know, their earnings are a lot more choppy because they depend on the housing cycle. So we tend to prefer the companies with more recurring earnings. You know, obviously companies that are run by capable management, you know, people who are conservative and honest, etc., who are there not just to help themselves, but to hopefully grow wealth for shareholders. Companies that can grow over time. And if you think about Woolies and Coles, for example, you know, the population of Australia will continue to grow over the next 5 to 10 to 20 years, which obviously will help their supermarket sales, you know, very simplistically. And of course, then you want to buy those sort of companies at a reasonable price. And of course, that's the thing that's the big unknown in the share market. You know, shares can be very volatile. But it's, as I said, it's all about trying to buy, you know, good quality companies that make money, that pay dividends, trying to buy them at the right price. And certainly, I guess, when markets are falling, is not a bad time to be perhaps looking at buying some of these companies. Again, depends on your personal circumstances. But yeah, you know, while it's very painful when markets fall, you know, very unpleasant, it also potentially also will provide some opportunities at some stage. So that's really it, Natalia, at this stage. I don't know if there are many questions.
Thank you, Anton. Thank you so much. So I do have some questions, and I'll begin with my questions. So my question is around again superannuation funds and their performance. So because of all this volatile share market, so are we expecting the superannuation funds, like large superannuation funds, retail funds, or industry funds, to have negative returns the next year? What do you think?
When you say the next year, obviously the end of June, you know, for the FY22 finishes next week. Next week it will be the results. Obviously, super funds were looking quite good till December. Obviously, the large falls in share markets and the rise in bond yields, which means the prices of bonds have gone down, means I think that the results for the June 22 year will be quite mixed when they come out. You know, some of them I think might be negative. We'll have to wait and see. Obviously, there's a few more days to go, but it's not going to be a very good return in financial year 22. When you look into next year again, given all the uncertainties, Natalia, it's a little bit hard to know what's going to happen. I think, you know, the first, the 6 months to December, the first 6 months of next year, financial year, look like they're going to be fairly challenging, I think, given that, central banks are going to keep putting up interest rates. But, beyond that, hopefully when they're, if they are successful in slowing the economy and slowing inflation, then hopefully things should get back to, back to normal.
So when do you think, how long do you think it will last? At least say 6 months, 12 months?
Look, it's difficult to know, as I said. The difficulty is, knowing, when is that inflation rate? How are they? When is it going to come down? And the danger, we saw this in 1990. For those of us who were around in 1990, and it was a very, unpleasant time in Australia when the RBA put interest rates all the way to 21%. When they wanted to slow, to bring inflation down. Now, nobody's suggesting interest rates are going to get anywhere near there because there's so much debt today compared to 1990. But I guess that's the uncertainty is unfortunately, the better the economy does, it means the central banks will have to keep putting interest rates down. So they're trying to engineer a slowdown, and they need to see the economy slowing. Unfortunately, that probably means they need to see unemployment going up before they're convinced that inflation is going to come down. So look, it's difficult to know, but I think the next 6 months, at least the next 6 months, are going to stay fairly volatile and uncertain.
Okay. What do you think about the conservative investments such as bonds or gold? Something where, that at least it's not that volatile compared to shares or properties, I guess, what do you think about this type of brick and mortar things?
As I said, I think as an investor, you have to have a diversified portfolio of good quality assets. I mean, how often have you seen, cash? Obviously, if you've had it all in cash the last 3 months, you look quite good because markets have fallen heavily. But then on the other hand, if you had all your money in cash for 2 years, you've been earning zero, on term deposits. So it's difficult to say have all your money in one thing or another. So, the only advice I would give people, which is not, which is pretty obvious, I guess, is to have a good diversified portfolio. You have to keep some cash for a rainy day. You always have to have, I think, good quality shares, because they, as I said, the good quality companies like, at the right price, your Coles, your Telstras, your Woolworths, they're not going to go away. They're going to be there longer than probably all of us on this call will be around for. They'll be around for many, many decades probably, making money and paying dividends. So you have to have some shares, and then property. You can either have real property, which obviously has been on a very elevated the last couple of years during COVID, or you can buy real estate investment trusts on the share market. So those are your options. So look, in terms of bonds, I think most people really, they're fairly safe now, particularly if you buy short-term bonds, 2 or 3 year bonds. The good news, I suppose, for retirees, if you have cash, is that term deposit rates are going up. So that's kind of what's bad for the share market is good for term deposits because rates are going up. So, look, as I said, it's about having a diversified portfolio. Gold is okay, but it doesn't pay any income. You got to store it somewhere. You got to insure it. So yeah, I'm not a big believer in gold. Holding bullion per se, unless you believe there's some big prices coming. So.
Okay. All right. Thank you so much. So I will open for other people to ask questions. Anyone else? Any questions?
Hi, Natalie and Anton. How are you?
Hi, Ni.
Thank you.
Hey, I'm just like everyone, devastated as we're just about to retire. We've lost a lot. What I'd like to know is, I'm at the stage of I basically have to take some of we've got a 7-year gap in between us, my husband and myself. So I have to transfer some of his super into my super, which I've just done because what else am I going to do with it? But I have to also do it again next year. So my question is, if I can leave it in the bank at higher interest rate, should I do that? And then chuck it back into super when I need to?
Well, look, again, I don't know your personal circumstances, and I think you should go and see a financial planner. But clearly, as I said, rates are going up. Whether you have your cash in super or whatever, your term deposit rate is going to earn more next year than they did last year, because I said that the central banks have really no choice. They don't really have any other weapon to bring down inflation than putting up interest rates. So, and now whether you hold it in your super or whatever, I'm not sure the answer is. You probably should get some financial advice. In terms of being devastated, I'd have to say, we've seen share market downturns before. This is not the first one. It won't be the last one. And as long as you're invested, look, and it is hard for everybody, including, imagine me, my job is to look at, the share market all day, every day. And, you're watching these shares that you've invested in fall every day. It ain't pleasant. It's not a nice feeling, right? But I think as long as you know that the shares you own are good quality shares, as I said, Coles, Woolworths, Telstra, they're not going to go away, and sure, the share prices might fall, but the companies themselves, will continue to move forward. Right?
Well, I'm not quite sure what shares are because it's in the supers, so they just take it and
Look, it'll be a diversified portfolio of mainly good quality shares. I'd hope,
And also,
I think it's more devastating. I'm saying I know everybody's going through it, but it's devastating when you're just about to retire, and you had your plan, and plan A just didn't happen. So it is harder for when you're just about, because you really can't, you've got to wait another 10 years to get that money back, and you can't put any more in because you're not working anymore. So it's a little bit different when you're 30 and you can afford to lose a bit because you've got all those years to catch up. But when you're actually at that point of finishing work, it is a lot more difficult. But at the end of the day, just sell your house, I suppose.
Well, as I said, it's tough for everybody. The whole world's gone through this. Look, at the same time, to be honest, we did have this big rally in markets, which to some extent were a bit, what's the word, a bit artificial, because the central banks and governments threw so much money at the world economy through COVID, so it's gone up and come down. But if you look, it's still a hell over 2 years, but obviously in the last 6 months, it's given up. Some markets, particularly overseas, have given up quite a bit of the gains.
Oh, we'll just have to wait and see, I guess, and hopefully Putin finishes doing what he's doing. Just finish him off. It's like, that's it, I'm done.
Look, Anya, also you have to be careful with taking money from super, putting back because again, I don't know your personal circumstances, but there are limitations. So you need to know and talk to your advisor about what you can put, what you can take, and be careful, because it's not always you can put it back, whatever you're taking. Okay, so, but like I said, you can always reach out and we can discuss this with you. I think, I have next question for Anton. What are your thoughts about holding in crypto? And can you SMSF earn trading? Okay, so what are your thoughts on speculative, I guess, investments, Anton, like crypto?
Just forget it. Look, honestly, good luck to you. If you want to gamble, I'd suggest the Star City Casino, and but honestly, crypto and all that sort of stuff, and all these Nasdaq stocks, which are all hot air, they don't make any money. It's very, very risky stuff, and obviously, if you're a conservative investor, you stay away from all that stuff.
Okay.
Is
Yeah,
my
just
advice. Is my
I guess
advice.
it depends on your risk profile. That's right. So
Yeah, look, if you want, as I said, if you want to gamble, you can go to the
Yeah.
casino, you can buy some cryptocurrencies, Natalia. It's up to you.
thank you, Anton. And again, forex derivatives of stocks. So basically, I guess it's a similar answer, right? With all this trading.
Sorry,
Also, the question: what about trading forex derivatives?
madness. Stay away from it. Madness. Honestly, it's a zero-sum game. I've tried to do it myself in my youth and whatever. Look, people trying to trade think it's easy to make money. I've always said, Natalia, you know, that the stock market is an easy place for the greedy to lose money, and it's a good place for the patient investor to make money. So that's the truth, you know. And people who think they can double their money on crypto or currency or derivatives, I mean, honestly, you know, good luck. But I'd suggest a trip to the casino instead, because it's more fun.
Oh yeah, especially at the moment when you know, like it's so volatile and everything is going down. So
it's not about matter of going down. I think it's a philosophy that one has to decide in one's life, you know, and I think we all get to that point. I mean, look, a lot of investors, I mean, I'd say people on this call are probably, you know, a bit older like me and more mature, but you know, we all learn our lesson one day. You know, we've all tried the get rich, the tip from somebody, and why don't you try this and why don't you try that, and it's, you know, it's a zero-sum game. You might get a win, you always hear about the person who's made money on crypto. You don't hear about the other 999 who haven't. It's like being at the horse races. You know, one person has a ticket and goes, "Oh, I've won," but you don't hear about the other people in the room who don't say anything. So look, I learned my lesson in the '87 stock market crash when I saw, you know, I lost a bit of money. It wasn't much, but it was at the time. It was for me. I was only 20 something. I saw a lot of other people lose a lot of money on specky sort of gold shares or whatever, and you know, Larry Adler and Alan Bond and all this stuff. And you know, my philosophy from that day was, I'm never going to speculate again, because it's too painful when the music stops, and nobody tells you when the music stops. You know, so as I said, you know, that's why this thing about buying good companies with strong competitive advantage, with recurring earnings, with capable management, you know, again, it's not a guarantee to make money, but I think over the long term, if you stick to good quality companies that make money, pay dividends, and that are managed by capable people, you know, you'll come out ahead over the long term.
Okay, thank you. So any other questions? I think all right, so I think if there is no more questions, then we might move to the end of it. So basically, yeah, thank you very much, Anton. Thank you very much, everyone. So to finish it off, so I want to say that again, so if you need more information about the strategies, if you need to know more about superannuation and the rules, and you know, look again how we can help you to grow your super, please feel free to give us a call, 1-800-327-978, or to book a discovery session with us. So if you're confused, if you don't know what to do, if your accountant, for example, is not specialized in SMSF, and you don't feel like they know it all, you know, we can definitely help you out. There is no situation which I can't solve in terms of superannuation. So please feel free to book an appointment, or if you want to send me a question or give me a buzz, so you are welcome to do so. But thank you so much, everyone, and thank you, Anton. I hope you got something out of it, and always remember that you know, like in downturn, bear markets, bull markets make you money, but bear markets make you rich. So always remember there are opportunities out there, and just you have to just stick to the right strategy and talk to the right people. But thank you very much, everyone, and see you next time.
Thank you, Natalia. Thanks for the opportunity. Thank you, everyone, for listening.
Thank you.
Bye-bye. Bye-bye. Thank you. Bye-bye.